What's up everybody, I'm Jaspreet Singh and the Federal Reserve Bank has meetings scheduled for June 14th and 15th and July 26th and 27th. Now while we don't know for sure what the Fed is going to do or say during these meetings, they have preemptively said that they want to raise interest rates by 0.5% in June and then 0.5% in July, probably during their meetings. The Fed acts reactively. They wait for something to happen. They wait for inflation to become a real problem and then they do something about it. Or they wait for the economy to get hurt really bad and then they do something about it. So they don't act proactively, they act reactively. However, I want you to be a little bit different. I don't want you to be reactionary. I don't want you to see something happen in the markets and then you panic and then you start making decisions. I don't want you to start looking at what's happening in the economy, you panic and then you start changing how you invest your money. Instead, I want you to be proactive, understand what's going on, make smart investment decisions today, that way you're not one of the reactionary people like the majority people who get scared, get panic, and then make rash decisions on emotion. I want you to make financial decisions. If the Fed raises interest rates by 0.5% in June and then another 0.5% in July, it's going to affect the stock market. It's going to affect the economy. It's going to affect the housing market. It's going to affect businesses and it's going to affect your debt. This is where, again, you want to be prepared and understand what might be happening, what could happen. That way you can make smarter decisions with your money. Now, I'm going to mention this right here in the beginning of the video so I don't have to keep saying it throughout the video, but there is a chance that the Fed doesn't raise interest rates. I mean, we don't know what the Fed is going to do until they do it. All we know is that they have said that they are interested in raising interest rates by around 0.5% in June and July. But again, we're not going to know for sure until they do it. However, let's talk about now what you should be prepared for. The reason why the Fed is working to raise interest rates is because they're worried about inflation. Now, at this time, we have two different entities. We have the government and then we have the Fed. The Fed, although it's called the Federal Reserve Bank, is not a federal entity. It's not a government entity. It even says so on their website. And the government is not in control of a monetary supply, although the government does have the Treasury Department, but the Fed is in charge of the monetary supply. Now, at this point right now, the Fed has been saying for a while that inflation is a top priority and they want to fight inflation. Now, President Biden and the government are also saying that inflation is their top priority. That's what they want to work to bring down. This is where you have to understand what inflation is at the end of the day, because inflation is when the value of your dollar goes down. That's what inflation is. And you get inflation when you inflate the monetary supply, because inflation comes from the word inflate. What are you inflating? The monetary supply. When you add more dollars without producing more wealth, without producing more actual value, the value of each individual dollar goes down. And between 2020 and now, we have added trillions and trillions of dollars into our economic system. All this caused inflation. We inflated our monetary supply, causing the value of our dollars to go down, causing the price of things to go up. This is where now the Fed is trying to reduce inflation, meaning trying to reduce the monetary supply, trying to reduce the amount of dollars out there by pulling dollars out. The way that they're doing that is now by raising interest rates, making borrowing money more expensive, which means less dollars enter our economic circulation. And they're also working to sell off their balance sheet. So now the Fed has less dollars, less assets on their balance sheet, because the Fed, although it's called the Federal Reserve Bank, doesn't keep any cash reserves. However, they have a $9 trillion balance sheet. The way that they bought these $9 trillion worth of assets was through printing $9 trillion and buying up these assets that no one else wanted to buy. So now the Fed is working to sell off these assets. That way we can reduce the size of our monetary supply and reduce the amount of inflation out there. That's what the Fed is doing. Now, at the same time, the government and President Biden say that inflation is a real problem and they want to start fighting inflation. However, you also want to pay attention to what these entities are doing relative to the words that they're saying. I'm going to talk about the Fed for just another second. Then I'm going to talk about the government, because this gets really interesting here on the government side. The Fed says that inflation is a problem. They've been saying it's a problem. And the interesting thing is they keep saying how they're going to fight inflation in the future. Up until now, even today, the Fed is still saying that they plan to raise interest rates in the future. They want to raise interest rates in the June meeting. They want to raise interest rates in the July meeting. They want to raise interest rates later in 2022. They want to raise interest rates in 2023. And then they want to work to sell off their balance sheet throughout 2022 and then in 2023. And they waited to start selling some of their balance sheet assets until June of 2022. If inflation is a real problem, like they say that it is, then why are they waiting to fight inflation? Now, the reason why they say is because they don't want to induce a recession. If they were just to jack up interest rates automatically, the stock market would crash. It could create a crash in the real estate market. It could hurt businesses. So they want to avoid that. So they're trying to create something called a soft landing. And a soft landing is where they're trying to reduce inflation slowly over time in order to fight this inflation problem. However, there's a chance that they could be wrong about this inflation again, because if this inflation is more severe than what the Fed thinks it is, and this soft landing approach doesn't work, that means they're going to have to get significantly more aggressive to fight inflation in the future. And that means that now we have a bigger bubble that we're going to have to burst. And that could cause a much bigger downturn, a much bigger crash, a much bigger pain in the economy. So that's the first thing that you want to pay attention to. While yes, they say that they're working to fight inflation, they're still hoping that it will get better with time, kind of by itself, without a major pullback by the Fed. The government, on the other hand, doesn't have the same ability to create inflation the same way the Fed does, because the government can't print money the way the Fed does. However, the government can spend money without actually having money. Remember, the government makes money through tax dollars. And if they don't have enough tax dollars to cover their expenses, what do? Well, they can raise your taxes, which would make a lot of people upset, or they can reduce some of your benefits. They can cut your Social Security, they can cut welfare, which would also make people upset. Or they can go and just borrow this money from the Fed, and then they can go and spend whatever they want, which in turn creates more inflation, which is more of a hidden, silent tax that now everybody has to pay for, but they don't really know where the root cause is. Like, even until today, everybody doesn't know where inflation is coming from. They're saying it's Russia, it's Ukraine, it's China, it's the pandemic, it's the supply chain issues. However, at the root, inflation comes from printing more money and creating more money, expanding the monetary supply. It's even in the word, inflation. You're inflating the monetary supply. So, while the government can't print the money themselves, what they can do is they can borrow money, spend money they don't have, and then this creates inflation. Like right now we have a $30 trillion national deficit. What does that mean? The government has spent $30 trillion plus some that they don't have, that they never earned. Where did they get this money? Well, they issued these bonds, treasury bonds, and they don't have enough people willing to buy these bonds. So then they go to the Fed and they say, hey, Fed, we want to go spend trillions of dollars on whatever. We want to do it on a stimulus package. We want to spend trillions of dollars on an infrastructure package, whatever it might be. We don't have the money to do it. Can you help fund this package? The Fed can then print the trillions of dollars because, remember, they're not a reserve. They don't have cash piles sitting somewhere. So the Fed prints this money, gives it to the government. Now the government has trillions of dollars to spend. So here we are today with the government, the presidential administration saying that inflation is a number one priority, that they want to bring down inflation as soon as possible. But at the same time, how do you bring down inflation? Well, you spend less money. You stop printing so much money. If you cut your expenses and now we stop printing money, that could also bring down inflation. However, we're not seeing that happen just yet. I mean, even till today, President Biden is talking about forgiving $10,000 worth of student loans for people who have student loans across the board. That is a very expensive package. We're still seeing more spending in places around the world, in different countries where the United States is funding billions of dollars worth of operations outside to help other countries. All these things are commendable, they're nice, however, they contribute to inflation. I mean, everything has a cost. Not to mention that we still have a multi-trillion-dollar infrastructure bill that's potentially in the works that, again, has to be funded by creating more inflation. Now, again, these things are good in the sense that, sure, infrastructure is good and it's good to help other people and it's good to have free student loans, but they all come at a cost. I mean, if the government can just print an unlimited amount of money, why do we have to pay taxes? I mean, why can't they just pay off everyone's credit card debt? Why can't they just give us a $10,000 check every single month? Because there's a cost to these things, and the cost is through inflation. If the government can't get this money through taxes, somebody still has to pay the price, and the person who pays the price is the average person who is either not financially educated or poor. And it's very unfortunate where now it disproportionately hurts the people who are poor. It disproportionately hurts the people who are not financially educated. And this is why you're starting to see the middle class really get wiped out. Because if you understand money, you're going to change the way that you use your money, especially in these types of times when you have super high inflation. And if you don't understand money, you're going to end up on a different end of the spectrum because now your savings don't stretch as far, your earnings don't stretch as far. And so you keep making your money, you're going to work every single day, but your paycheck essentially is smaller and smaller, even though the size might even be getting bigger because everything is so much more expensive. Gas is more expensive, groceries are more expensive, housing is more expensive. It costs money to live, but wages will never be able to keep up with the amount of printing that the government does. Let me show you exactly what I mean. If we go back in time to just over a year ago, to the beginning part of 2021, when we were talking about a $1.9 trillion stimulus package to help businesses, to help people, to help our economy grow, At that time, everybody said that there was no worries of inflation and there's no worries about this trillions of dollars being printed to fund the stimulus package causing more inflation. Even the Treasury Secretary Janet Yellen and President Biden talked about how inflation is not a problem, and they even said how the printing of the $1.9 trillion would not create more of an inflation problem. Now, here we are today, we're feeling the effects of inflation, and Treasury Secretary Janet Yellen has just come out recently and openly said, I was wrong about inflation, and I was also wrong about how the stimulus program would cause an effect on inflation. Turns out that printing money is going to cause more inflation, it's going to devalue the dollar, and it's going to cause the price of things to go up. And it's kind of funny because, I mean, it's like basic economics, right? I mean, if you don't have more wealth, but you keep producing more currency based off of the same number of wealth, the individual currency, our dollars, are going to become less valuable because we're not producing more wealth. The wealth is actual production. What is our economy producing? In 2020 and 2021, we weren't producing anything in our economy except more dollars. So our dollars lost value, which causes more inflation. And so now we're paying the price of that. And that's why the Fed is working to now raise interest rates to fight this inflation. However, we're still seeing more inflationary actions by the government. Now, the question is, if inflation continues to get worse or if it doesn't get better anytime soon, which is a possibility, of course, there's also a chance that inflation will get better, that what the Fed is doing is working and our economy recovers and everything is fine. However, if they're wrong and inflation continues to not go down, well, then maybe the Fed would have to take more drastic action, and maybe it would force the government to take more drastic action, meaning cut back on spending. And the issue is when you do it too late, well, that's when it becomes more painful because now you're reactive. You have to take more reactive measures to fight inflation. You have to get more aggressive on cuts. And so now if you're doing spending cuts, that means you're doing less investment in the economy. Maybe you cut back on programs, social programs, and these things now become more painful because, well, you hope that you don't have to do it, but if the bubble gets too big, somebody's going to have to pay the price. This brings me to what you should be doing right now. Now, the first thing I want to say is, of course, you want to be aware of what's happening in the finance and business news, and it's more important now than ever. And if you're looking for an easy way to do that, you can check out Market Briefs. It is a free financial newsletter that I created where our team breaks down the top finance and business news into a fun, easy to read, entertaining, and witty email. You can read it in less than 5 minutes every morning, and now you don't have to spend hours reading through a bunch of different news sites. In less than 5 minutes, you're going to know what's going on in the stock market, the real estate market, the inflation market, the global economy, and everything in between. It's a super fun email. I promise you, you are going to love it, and it's completely free. So if you want to join Market Briefs and start reading what's happening in the financial world for free in 5 minutes or less every morning, I'll put the link to how you can do that down in the description below. Beyond that, the next thing that I want you to do right now is if you have any sort of variable interest rate debt, like credit card debt or home equity lines of credit, which are variable interest rate, be more aggressive to pay it down right now because there's a good chance that the Fed is going to raise interest rates soon. And if they do that, that means that your debt payments are going to become more expensive. Even if your debt balance doesn't grow, the payments are going to get more expensive because the interest rate on your balance will get more expensive. So be proactive there and try to pay down the variable interest rate debt as fast as possible because it is going to get more expensive. The next thing is avoid variable interest rate debts. That means avoid credit card debt, avoid those sorts of home equity lines of credit, especially if you're just buying consumer expenses, because all these things are going to get more expensive, at least in the short term, as the Fed is working to fight inflation. And if they stick on this fight, we could see interest rates rise even more significantly. Again, I don't know where the Fed is going to go in the future. Are they going to continue to fight inflation? What's going to happen to the economy? Will they change course and start fighting a slowing economy? But you don't want to be on the victim side of this, where now all of a sudden your debt payments cost you 50% more today than they did just a year ago. So make sure you're being proactive, avoid the variable interest rate debts. And that also means that if you're looking to buy a home, avoid the adjustable rate mortgages, because the way that adjustable rate mortgages work is you get a short teaser rate. Maybe it's 5 years or 7 years. And then after that teaser time, your interest rate is going to readjust, and it's going to readjust to what the market is. And it's impossible to say where the economy and the markets are going to be in 5 years or 7 years. You're taking a gamble, and you're taking a gamble with the place that you live, where your family lives. It is not worth it. What you can do is you can take a fixed rate mortgage, and then if mortgage rates do go down in a few years or 5 years or whenever, you can just refinance into a lower interest rate home. But if mortgage rates go up, well, now you're kind of stuck because now, yes, you can refinance, but that also relies on the fact that hopefully home prices will be higher. Because if home prices don't go higher and you can't refinance and mortgage rates are higher, well, then you're going to be forced paying a significantly higher mortgage rate. So avoid the gamble and just lock in a fixed rate mortgage. And if mortgage rates go down, just refinance. And finally, the last thing that I want to talk about is look for discounts, not at Macy's, but look for discounts in assets, whether it's stocks, whether it's real estate, whether it's cryptocurrency. Look for opportunities. And opportunities always arise when you have uncertainty because investors hate uncertainty. However, like Warren Buffett says, be fearful when others are greedy and be greedy when others are fearful. So that means put some extra cash aside now. Do whatever you can to live a little bit smaller so you have some extra cash, and look for those opportunities because the majority of people will get blindsided no matter how much I talk about it, no matter how much we talk about what's going on in the economy and things to be aware of. When an opportunity arises, you want to make sure that you can capitalize on it. And in order to capitalize on it, you need the capital and you need the education. And the best time to prepare is when times are okay and when times are good. So if you spend that time doing it now, then you'll be ready. That way, if something happens, if you see a distressed asset, you can come in and buy. And let's just say now, nothing bad happens. Everything goes better. The economy gets better. Inflation goes down. Asset prices go up. Then, well, at least you have some extra cash. And now you have some extra money. You have a bigger bank account. So the worst case is you have a bigger bank account that you can use to now go out and buy assets later on. So be prepared, be ready for anything, and just prepare by understanding what might be coming. That way you're proactive, not reactive. If you enjoyed this video and you want to see the 7 investments you should make next time you see an economic downturn or a market downturn, that way you can build wealth, I made a video covering that, and you can watch the video by clicking this button right over there. Thank you for watching, and as always, keep hustling. Uber, Instagram, WhatsApp, all of these companies were created during a recession.